Well, let's get through the employment numbers today. As we told you, the rate jumped from 3.5% to 3.7%, with a net 15,000 jobs lost in July. But look, July can be a bit volatile for jobs. It's the start of a new financial year, so people do change jobs. It's school holidays as well. Let's try to work all this out with AMP's Deputy Chief Economist, Mousina, who's with me now. Deanna, always good to have you on the program. Do we read too much into this, or is this the trend that the Reserve Bank, Treasury, the government are kind of expecting?
It is a bit of a difficult one because, as you said, there are some seasonal factors that are going on, which the ABS said themselves. It does seem strange to say that, though, because the data is seasonally adjusted. So we should seasonally adjust all these weird things away. But I do think that COVID-19 has led to some disruptions in the labour force, seasonal factors that can make it a little bit more difficult to read. Look, I think that there's both an element of slowing demand for jobs, which we can see across other indicators of employment, leading indicators of employment growth, and also some of these seasonal adjustment issues that are affecting the labour force figures. I think in the next few months, the unemployment rate will still head higher from here. Yeah,
it's interesting because that participation rate was just off a little bit. This was the key, though, I thought. The full-time jobs dropped by 24,000. Part-time jobs rose by just under 10,000. And that's where the net 15,000 jobs lost came from. You know, that's the trend you want to see, because if employers start to drop off their hiring in regards to full-time workers, that's where you'll start to see this start to rise, which is the forecast of the Reserve Bank.
Well, we've also seen full-time jobs growth extremely strong relative to part-time jobs over the past year. So it could just be a little bit of payback from that, because we do know that the jobs data does run a bit hot and cold. When you get a few months of really strong prints, you often get a month of a negative print like we saw in July. So I think we need to wait a few more months to see if that's actually a new trend. But I do think it's important to keep in mind that the unemployment rate is probably the last indicator in an economy to turn when you do have a change in the cycle, because employers don't want to lose people until they really have to. So when we get that downturn in the economy, the unemployment rate will turn after that fact.
But as you can hear, we're reporting all these profit reports from all these companies. They're conscious of the inflation, and we're talking to the chief executives about where they're seeing the inflationary pressures. They're saying it's about wages and obviously the jobs. But the reality is the profits are still pretty strong. So they seem to be in a position to hang on to their workers for now, at least.
Well, for now, certainly. I mean, the economy has held up a lot better than where the Reserve Bank was forecasting it to, and most economists as well. And the labour market has also been tighter. So the reporting season here has still looked pretty good, just like it has in the US. But I do think that we are starting to see that turn in consumer spending stocks and also in consumer spending volumes in general. I mean, retail has had negative volumes growth now for the past 3 quarters. So it's just the start of that weakness in the consumer story.
OK, so one other aspect of this is really the Reserve Bank. This almost gives the Reserve Bank another reason to sit back, look at more data, look at the next set of unemployment numbers that come out and the inflation number. They really don't need to do too much, because all of the signals are pointing that those 12 interest rate rises are starting to move.
There's no hurry for the RBA. There's no hurry at all for the RBA. They've held rates steady for the last 2 months. They had the wages data this week that showed that wages growth is clearly not an issue. We don't have a wage price spiral. They can sit pat in September and be quite comfortable with that. If we do see renewed signs that inflation's picking up or that there is a wage breakout, that's when we can start to talk about another rate hike. But for now, I don't think that it should be something that they should even consider.
I'll try and bring the graphic back up for you again, but you heard Ed there talking about the Australian dollar, because that sort of is in the mix of all of this. There's been suggestions today from the Commonwealth Bank, I heard, that they see the Australian dollar under 60 US cents. It's at 64 right now. I'm not sure, but the fact of the matter is, where the Reserve Bank goes with interest rates by doing nothing, when you've actually got the pressures from the United States overnight saying they could raise rates again, it really does put our own currency under some pressure, especially when China is so weak.
And the currency could have some more short-term downside, especially with the risk-off environment in markets and globally. But does that have a direct impact to imported inflation? I think the more important driver of domestic inflation is what happens to wages here. And without a wage price spiral, wages getting above 4% on an annual basis, I don't think that we're in for a risk that inflation's going to reaccelerate here.
Yeah, it's really interesting because you see the dollar and you can see it's come off today here. So 64.03, obviously still very strong against the Japanese yen, weaker against the pound and the euro as well. And there's so many different moving parts that do contribute to the Australian dollar that people need to understand, don't they?
There's plenty going on right now. There's a very strong US dollar because of the risk-off environment, weak Chinese data and just concerns about the Chinese economy in general, rising global bond yields, which has also led to upward pressure.
That's another thing. Those US bond yields last night, the highest in 15 years, the long-term bonds. So again, pointing almost to a recession in the United States. Whether it happens or not, it's another matter.
It could be a sign of that, but it also could be a sign of investors getting concerned that interest rates next year will have to be held at a higher rate. And I think there's also a lot of concern that the US fiscal position has deteriorated significantly because of the Fitch downgrade, but also more generally that the budget deficit is going in the opposite direction to where most rating agencies want it to go. And I think investors want to be compensated for that risk because there's a huge chance that the US has a government shutdown in October.
Compensated for risk, that's the key. Mousina, always good to have you in the program. Many thanks for your time today.